The stock market's recent performance has left many investors on the edge of their seats, as the Dow Jones Industrial Average narrowly missed achieving a record high for the year. On Friday, the market experienced a mixed bag of results, with the Dow inching up by 35 points, which translates to a modest increase of 0.08%. In contrast, the S&P 500 dipped by 0.29%, and the tech-heavy Nasdaq Composite saw a decline of 0.4%. At the start of the day, the Dow had actually opened in record territory, surpassing its previous intraday high from December 4th. However, as the day progressed, it fluctuated and ultimately fell short of closing at a record high, needing a gain of approximately 103 points, or 0.23%, to achieve that milestone. As it stands, the Dow now requires a gain of about 68 points, or 0.15%, to officially set a new all-time closing record. Despite some underlying economic turbulence, Wall Street has maintained a sense of optimism. However, the momentum that had been building throughout the week seemed to wane as it came to a close. Notably, all three major stock indexes managed to post consecutive weeks of gains, which is a positive sign for investors. On Friday morning, stocks faced pressure after the University of Michigan released its latest consumer sentiment survey, revealing a 5% drop in August. This marked the first decline in consumer sentiment in 4 months. Primarily due to rising inflation concerns, the Dow made attempts to climb higher, buoyed by a significant surge in shares of UnitedHealth, UNH, which jumped by 12%. This spike followed the announcement from Berkshire Hathaway, BRKB, on Thursday afternoon, revealing a stake in the healthcare giant, which sent UnitedHealth's shares soaring after the market closed. However, it's worth noting that UnitedHealth's shares have plummeted by 40% this year, while the S&P 500 and Nasdaq have celebrated 18 and 19 record highs, respectively, this year. The Dow is still in pursuit of its first closing record. Hopes surrounding a potential Federal Reserve rate cut next month have contributed to the recent stock market gains. The Dow has experienced a remarkable rebound, surging approximately 20% since it hit a low point in early April. In recent weeks, it has been flirting with the idea of closing at a record high, as investors have attempted to overlook concerns regarding President Donald Trump's tariffs, despite evidence that these trade policies are driving up certain prices. The market has been supported by a strong corporate earnings season and unwavering investor enthusiasm surrounding artificial intelligence, AI. Earlier this week, stocks surged after the Consumer Price Index, CPI, data for July indicated that annual inflation rose in line with expectations, which helped to calm Wall Street's nerves and strengthened the case for a Fed interest rate cut in September. In just 2 days, the Dow skyrocketed by 947 points, or 2.15%, while the S&P 500 and Nasdaq it reached back-to-back record highs. Analysts at Deutsche Bank noted that investors were initially concerned that a hotter-than-expected inflation number could eliminate the possibility of a September rate cut, especially if the impact of tariffs became more pronounced. Therefore, the CPI data being broadly in line with expectations was met with relief. However, the stock market rally hit a pause on Thursday after the Producer Price Index, PPI. Data for July revealed that wholesale inflation had risen at its fastest monthly pace in 3 years. This unexpected increase in producer prices dampened hopes for clarity regarding Fed rate cuts in September, leading to a dip in stock prices. Nevertheless, investors managed to shake off their worries in the afternoon, resulting in a flat close for the day. Traders had begun to fully anticipate a Fed rate cut in September, according to the CME FedWatch tool. But by Thursday, they adjusted their expectations, now pricing in only a 7% chance that the Fed would maintain current rates. Clark Garanon, chief market strategist at Calbay Investments, commented that Thursday's PPI data was much stronger than anticipated, suggesting that tariffs are contributing to inflation, which complicates the Fed's potential rate cut plans this fall. Despite the uncertainty surrounding the economy, stock market investors are currently embracing optimism fueled by robust corporate earnings and the prospect of a potential cycle of Fed rate cuts. A reduction in the Fed's benchmark interest rate is often viewed as a catalyst for stock prices to rise, as it can lower bond yields, making stocks more attractive to investors. Additionally, lower savings rates can encourage spending and investment. Interestingly, market volatility has decreased, with Wall Street's fear gauge, the CBOE Volatility Index, reaching its lowest level of the year this week. Scott Ladner, Chief Investment Officer at Horizon Investments, remarked, "We just got through earnings season with good earnings, a Fed that's about to embark on a cutting cycle, and Trump doing micro-level disruptive things, but not macro-level disruptive things. We don't see a whole lot of massive headwinds. This year has been quite a roller coaster for the U.S. stock market. Back in early April, the Dow had plummeted 16% from its previous peak in December. It was on track for its worst April decline since 1932, before President Trump paused his initial Liberation Day tariffs, which quickly lifted stocks out of their slump. The SP and Nasdaq reached record highs on June 27th and have continued to climb since then. The journey for the Dow is still ongoing. On July 23rd, it closed just 4 points shy of a record high before pulling back the following day. The index has faced challenges from companies like UnitedHealth, Salesforce, CRM, Merck, MRK, and Apple, AAPL, which have seen declines of approximately 40%, 27%, 15%, and 8% respectively this year. On the flip side, the best-performing companies within the Dow have included NVIDIA, NVDA, Boeing, BA, Goldman Sachs, GS, and Microsoft, MSFT, which have experienced increases of 34%, 33%, 28%, and 23% respectively this year. Notably, NVIDIA was added to the index in November, replacing Intel, INTC. The Dow, officially known as the Dow Jones Industrial Average, has a long history dating back to 1896. Initially, it included just 12 companies, but it expanded to 30 companies in 1928. Over the past 97 years, various companies have rotated in and out of the index, reflecting the changing landscape of the U.S. economy. In contrast, the SP 500 tracks 500 companies, providing a broader scope of the market. While the Dow may not encompass as much of the market as the SP 500, it remains an iconic symbol of the U.S. stock market. Sam Stovall, Chief Investment Strategist at CFRA Research, noted, "It is the sentimental favorite because it is the oldest. More people have been familiar with it. The SP 500 was established in 1957. Although earlier versions of the index existed in various forms since the 1920s. The tech-heavy Nasdaq Composite was introduced in 1971. Stovall pointed out that while the Dow is widely recognized as synonymous with the U.S. stock market and Wall Street, the SP 500 may not be as well known. Although the Dow has yet to achieve a closing record high this year, it's not just the SP 500 and Nasdaq that have reached all-time highs recently. Japan's Nikkei 225 also hit an all-time high this week, and the MSCI All-Country World Index, which tracks shares globally, also reached a new record high.